Okay, great. All right. So I was just looking at the S&P and how we're definitely in an uptrend right now. This back in January, right around, where is it? Around right here, we had a bullish momentum indicator by Walter Deemer, and it was like several days of advanced decline in a short period of time. And that's basically carried us the whole way up to where we're at right now. But you see, the exact spot where we're at is the resistance we had back in August. So, so past resistance, this could be like a spot where we pause for a while. Um, our last level of resistance is right here. We talked about that last week. And then right here. So right now we have overbought, look at it, 90 on the stochastics. When it gets to above 90 and above, that is super overbought. But that doesn't mean we can continue to go up higher. So it's a very cautious time to buy stocks because usually when people are greedy and when people are super greedy and people are bullish, that's the opposite of what you should be thinking about doing in your buying and selling. Okay, let's look at, all right, let's look at, for a change of pace, what's going on in, um, last week we had this news story about how Amazon might be acquiring Dish and working with them to make a new phone service. And we said at the time, Dish had subpar auction, I mean, bandwidth for their phone service. So it wouldn't be that great of a service anyway. Now they're actually talking about going bankrupt. So Dish, right? Right there was I pulled up Dish Network because we looked at it last week. This is the exact kind of stock that you have to look at and say be very careful around, because you see, last year we had it 361 in earnings. This year it's 99 cents, and then it keeps going down to negative. Into it, I'm looking at this spot right here. So it's basically declining earnings, and it doesn't look very good for the company. They had a story out today that they might go bankrupt. So I'm sure a lot of the telecom companies will be bidding for their bandwidth for cell coverage, but that's probably the only thing that's worth anything in their company. All right, so what we're going to do is we're going to look at our stock market calendar. Okay, so we got a busy week in front of us. This is at the end of June here. I put caution, this yellow, because right now we're overbought. So it's really hard to get really excited and expect it to be going higher. So it's right here. Next Wednesday, we're going to have a Fed meeting. They're expected to maybe raise one last time or keep it at where they're at. So whatever they say there, if they say something dovish or their commentary, they say something that the market likes, we'll go up. Otherwise, we'll be still in this overbought stage. We do have a holiday next Monday, not this Monday, but next Monday. That's people get really busy around that. So I put the days around that to be green because people are excited about getting time off, and the market a lot of times doesn't trade as heavy volume, and so even though we're overbought now, that could be just a little carrying over of good feelings. Then we have end of quarter window dressing. So all the stocks that have done superbly this quarter, there's mutual funds and hedge funds that are going to be trying to catch up. So the Nvidias of the world, Microsoft's, everyone who's overperformed in the stock market will probably bought the last 2 weeks of the month just because they want to pad their portfolio to make it look like they've made that same straight trade. And then we have July 4th. holiday to look forward to. So we have a bunch of holidays back together here, along with the end of the quarter wind addressing. So that's really good indication that we could be doing good. But the way things are going now, we have this Fed meeting, and if we rally into it, we buy in the rumor and sell in the news, and that very well could be good or bad based on what they say. That's what Joe was saying. But July is typically a month of the year. So if we look at our calendar, June is typically not that great. Earnings that don't come out in June, we have just a lot of people on vacation, no excitement really, no news coming out. And July is a really good month. So we're looking forward to this July 4th holiday. Everyone celebrates that. It's very patriotic. So that's why we expect a lot of good market action to the upside during that time. And we have another Fed meeting to look forward to at the end of July. I marked that in light blue. So we go to the August and September are traditionally bad months. So just think about that as you make a portfolio, and understand that we're going to have some bad times. Some of the worst stock market crashes in history happened in October, and every trader knows that and has it in the back of their mind that maybe there's a crash in October. But for me, I'm buying and holding. I'm just understanding that during high interest rates environments, people pay less for stocks, the multiples go down, and whenever you have low interest rates environment, people pay more for the same thing. Okay, so let's look at some of the numbers. Okay, I mentioned that we're going to have a holiday next Monday. You see Fed's meeting. What they're doing with interest rates is doesn't really affect the market anymore because it's all priced in, and everyone knows we're near the end of the tightening cycle. So 10-year and the 2-year, they're going up, but they're not as consequential as they were before. We were following them like a hawk last year, but now it's not as important. Let me see. Okay, we have a situation where a lot of the stocks in the S&P are trading above their moving averages. So that is an indication of momentum. But we are let's look at the S&P chart right now. We are at a point where we're overbought. We have a 90 in the stochastics, and we're basically at a point where we were last August, and there was resistance there. So there's a very good chance that we have a double top. That this could be a spot where we go back down some, because we have a combination of this whole market being bullish. Let's look at our fear greed. We have extreme greed this week. So we have to look at this as a contrary indicator. Whenever people are extremely greedy, we got to be fearful. And whenever people are fearful, we got to be greedy. So right now, it's not the time to buy stocks. We're just overbought, and it's just a position where the market does the opposite of what you normally would think it would. So if you think it's going to be going up and people are greedy, it does the opposite. So let's look at, okay, what other notes we need to say here? Okay, so let's look at the S&P and the support lines. Okay, right now we have this level of resistance right here that's been holding for at least a year. So and it looks like we're still within that range. We broke out of this other resistance that we've been in. Now it's going. We have this whole range. Looks like we're topping out here. So next and we're in an uptrend. So if we look at these higher highs, higher lows, we'll most likely go back down to this low, and then keep on keep within this higher highs, higher lows, like that. But that's just something to keep in mind when you're managing your portfolio and buying new things. It's pretty dangerous right now. All right, so let's look at the variables in the stock market. Oil isn't changing at all. We had no real change to the dollar index or gold. Gold's down just a little bit. We see fear greed. I already talked about that. We're extreme greed. The VIX is down another 9%. So I did a chart for 10 years on the VIX, and this is like, the VIX is where it was pre-COVID. This is the COVID time frame, and we're back to normal and a bull market, like if the pandemic never happened. So whenever there are people that actually sell whenever the VIX goes down to 13, and then they buy whenever the VIX goes up above 30. So that's just it's a contrary indicator. That's another indication that it's pretty dangerous now. All right, so our valuation, emotional valuation chart. You can see we have media attention. I don't know if you looked at some of the magazines these days, but almost everyone that does finance says we're in a new bull market. And that's getting people to jump in at the last second. And just when people that's on the front page, oh, we're at a bull market again. There's a new paradigm, AI. And then we're starting to go down, and before you know it, we're going to be capitulating again. So don't get sucked into buying at the top, because we're there right now. And you just have to wait for people to be fearful again before it's a good time to buy. I cut out some of the most prominent stories in the recent days. CNN yesterday, it's official, we're in a bull market. And what does that mean? It just means since last October, last October, right here, from last October's lows to where we're at right now, that's 20%. Whenever it hits from a low to a high to 20%, they call it a bull market. But in reality, I don't think it's a real bull market, because we were up here before, and we're down here 2 years later, and we're lower than we were before. So it's all something for the headline, but in reality, we're overbought, and the next stop is probably a little bit lower. But there's another one. That's the Yahoo Finance. 500 enters new bull market. So, but when a trader looks at that, they say, okay, we got some suckers jumping in at the last second. I'll sell some right here and wait for it to go down. And so you have to think like that trader and not buy if you're a buy and hold person, and just wait for it to go down. Any good news stories that you see right now, like if you see Carvana stock explodes, GM, Tesla to expand network, you got to say, okay, put that in the back of my mind. Okay, that's great. Whenever everything's crashing, then we'll go look at these stocks, because right now it's like it's pulling people in at the top of the stock market. All right, so let's look at some of our notes for today. Is there any questions? Anything anyone wanted to go over? Great. Okay, so this is Walter Deemer. Oh, you had any questions?
Yeah, so I'm, as you know, I'm mostly, kind of index buy and hold investor. But for like this trading, I guess it might be interesting if you think anything that you're in is a little too bubbly. If I'd want to, this might be a time to trim positions, to build some dry powder.
Oh, absolutely.
Yeah, so trying to identify those, I guess, is something I maybe should go through my portfolio and look for those.
Yeah, I made a very small change to my portfolio, but it was based on some news that came out, so yeah, this is actually a time. Whenever I say don't buy, it could be, if you have some positions marked for exit. Like I have a couple positions marked for exit. I want to eventually get out of Verizon. There were some unprofitable car charging companies I wanted to get out of. So there's a couple companies that I marked for getting out of, and this is the time to do it when everyone's super excited and the stock market's going up. I guess for next week, it'd be good to go over all these very small percentage stocks in my portfolio and see which ones aren't panning out and get rid of them and clear it out, because we're at the top, right now in a way. So might be a good time to do that. Anything else you want to have any comments?
No, that was it.
Okay, so what I did was I looked at Walter Deemer back in January, right about here in this time frame. Walter Deemer flagged it as a BAM time. It's a momentum indicator, and he meant that back in the 1970s as whenever the advanced decline over a certain period of time is like 80% advanced decline ratio for a period of time, like 5 days in a row. That is an indicator that the stock market's going to be really good a year from now. So we saw that, and we noted that our downtrend was basically being broken at that time, and that led us to a belief that we were basically going to make higher highs, higher lows. And we got an update from Walter. I mean, this bullish, this breakaway momentum, that's what he calls it, BAM. Breakaway momentum is a term coined by Walter Deemer in the 1970s to describe powerful thrust evidenced by 10-day advanced decline ratio of 2 to 1. In almost all cases, the signal occurred near the beginning of a new bull market or a new intermediate up leg of a bull market. So you can see it didn't happen very often. I mean, this is going back to 1945. We have 1, 2, 3, 4, 5, 6, 7, 8, probably like 25 times that happened. And it happened in January of this year. So he basically updated it. He says, the one in January seems to be working. So that's an excellent confirmation from our technical expert here that we're starting something, starting a new bull market. And now all the media, they're giving this attention, this 20% difference between the low and the high. But in reality, we're still lower when we were 2 years ago. So we're still recovering from, the interest rate problems. Let me see. All right. So another little thing we've been saying for a while, but this guy kind of summarized it pretty good. I don't think we've ever seen such a concentrated few winners. 6 stocks represent 100% of the gains in the S&P 500 in this year. So if it wasn't for these stocks' performance, this S&P would be down or flat this year. So fortunately, we're following almost all of them, and it seems like when we were talking about the mutual funds and how they still hold these majority of these stocks in their portfolios, and some rotated into, we were saying like a month or two ago, some were rotating into Nvidia, into Meta, and they were holding the other ones in this list. And so the lesson learned from the beginning of this year is if you do have, a super sell-off where you have 30% down year, if you're interested in a buy and hold strategy, that is the time to start dollar costing, just buying a little bit at a time into some of these quality stocks. And because over time, these return around 10% or more a year. So, but yeah, so far this year, it seems like what was happening is these stocks were going up, and that was making the stock market averages go up, like the S&P went up, but it's pulling right now all the other stocks with it. So we have, in the last week, we have something called the Russell realignment. There's the Russell 2000 index, and every year they do this realignment where they reposition the percentage of stocks for each of the stocks in the portfolio. And so that gave a kick in the pants to a lot of the small cap stocks. And with the big stocks going up like this, now that's pulling up the smaller stocks, and it's leading to a broad-based momentum. But just when all that happens, it'll start going down, but because that's just the way things are. Where it, kind of peak stochastics, peak, going back to a previous high. So it just makes sense right now. We'd be pulling back at least until we go to the bottom end of this upward trend line. Okay, so let me see what else. What else do I have in store here? Okay, I just cut out some news stories. Boeing continues to have quality control problems. I used to work at Boeing, and I know from being there, it's quality control isn't that great. And this leads me, even though they have a duopoly in the making of big aircraft, they're still having quality control problems. So for a buy and hold company, I'd have to wait for this stock to be like undervalued, like half of, like maybe down $100 a share before I'm interested, because there's a lot of room for error here. I mean, there's not a lot of room for error because it's overpriced right now, and every week we have another quality control problem. So we'll wait for this to go down before we start looking at buying it. You see, Pepsi. I just wanted to show you that Pepsi is actually one of the stocks that did really good last year. It was still one of the only stocks we're following that was in an uptrend the whole year. It is at this point out of favor because the stocks that are quality, dividend, growing stocks that consistent demand, they can raise the prices. That did really good last year, but this year, almost every one of those stocks that did good last year are underperforming this year. And so it's actually super oversold. You can see it's down at the bottom of its channel if we're tracing the higher highs and higher lows. And I'm going to review some of the quality dividend portfolio later on, and this is one of the stocks that is in that list. And if you don't have a good portion of your money invested yet, this could be a good time to get into a Pepsi. Yeah, I've held this since 2010, and it's been kind of this straight line the whole time. I think because there's a constant demand for this kind of product. Specifically, Pepsi has Frito-Lay, and they have they have the biggest snack business in America. All right, so another article that came out, that this was really, really, we flagged it last week, or the week before, when Ford agreed to use Tesla's charging network. Now GM said they're going to adapt to that standard too. So that basically kills off a lot of these other charging stocks that we're trying to get a good network in place for the next charging company for that industry. Now GM is actually making, as of 2025, all of their cars use the new standard that Tesla came out with, the North America charging standard. We've been waiting for something like that to really happen. I guess back in the 80s or 70s, you had the VHS standard. There was a Betamax, and as soon as VHS came out, you knew you didn't want to get a Betamax video because then it wouldn't be useful. Now it's like the same thing with these, the charging companies that I thought ChargePoint was like one of the largest charging networks in America, and they had like an early mover advantage. But I guess Tesla has a better technology. They have the supercharger connectors. I guess it charges it faster, and looks like they're going to have a standard that's going to be implemented. At least having Ford and GM, that's a good portion of America's new car manufacturing. So my initial, it was like a lottery ticket for ChargePoint and Blink. I knew they were losing money, but they could potentially gain some market share if they had a standard adapted over time. But I guess one thing about investing is once your thesis is proven to be wrong, you have to commit the error and sell off, that that mistake. So it looks like I saw Ford last week decided to go with that standard, and now GM is. The next steps are Volkswagen and every other car manufacturer is going to use that standard, and then Tesla will have like a monopoly. And just think if they can become an Exxon Mobil for charging, and every car in the United States is going to be electric eventually. So if that happens, then Tesla has like a monopoly in this standard. I'm not sure if they'll be able to how they're going to make money for that. It's not in the earnings right now, the earnings estimates, and we're going to watch that. Um, any comments on this? Right. Okay, that was a good thing to go over. And what I did is I put together Tesla's charts. They've been in a downtrend. This is basically opposite of what the other tech stocks have been. The other tech stocks have been, going up a lot this year, and they're starting to break out of that right now and go into this higher highs, higher lows. And I think they were. Morningstar says that they've been going down like this because distraction that Twitter has on the company. Because if Elon Musk was paying a lot of attention to Twitter and not this company, then this company would not do as well. And now that they have a CEO for the Twitter company, that could be a tailwind for this company to pick up, where all the other big cap stocks are. So, so I don't know. I don't know how to. Right now, whenever you're an investor, you can't totally rely on the earnings summary. So what I did was I checked out the earnings summary from this morning. What we have here is it's still at 15.30. It's like 20% averaged over the next couple of years. But if you can somehow put together what they would make in charging fees, if every vehicle in America is using their standard, you have to like go on a napkin and calculate, well, what's ExxonMobil making? They have a 40% share of the United States gas market, and they're making this much. And you have to like figure out, how these could possibly change, and make a leap of faith to say, well, they're probably gonna have $9 a share in earnings whenever that standard becomes used with every car in the world in 26. So I don't know. That's kind of the back of the napkin thing that you have to figure out for yourself. And I thought that'd be an interesting little thing to go over. And the stocks that fell today because of that news, all these charging stocks that were trying to make it, trying to build out their networks, they basically borrowed money to build out their networks to be the standard. So they had a lot of stations and everyone had to use them. And it very well could be the Betamax that, no cars use that technology anymore. And it's still being figured out, but if the two big car companies in America are going with Tesla standard, maybe these other companies have to license Tesla's supercharger technology. They won't make as much. So I thought that was an interesting little thing to go through. Okay, so I went through Tesla's statistics. We do that like once a month or so. But their return on equity is pretty good. Hold on for 1 second. Okay, not my voice was cracking. Now it's better. So it looks like their the PE is 65. Okay, so that's like double their growth rate is around 20% right now. So if their PE is 65 or 69, the PEG ratio is about 3 times. It's 3 times overvalued right now. But the intangible thing about Tesla is they keep coming out with these new products out of nowhere that turn out to be something big. like the charging could be something like an ExxonMobil in what they receive in money. And they're talking about robo taxis, and if that happens, then that might um, allow them to be a taxi company. And so whoever makes these, we're going to keep track of this. Maybe next month we'll go over these and see if they change based on how much money they might make in charging. But it's always good to keep in mind that it's still overvalued. Yahoo Finance says it's 2.5 times overvalued. But their profit margin is really good, and the return on equity is really good too. And I think that their advantage in the car industry is the first mover. They have the biggest market share right now, and they're reducing their prices, and everyone else has to reduce their prices. And I think they have a sustainable advantage with their battery manufacturing and their technology. So let's see. We'll keep our eyes on that. And it seems like Morningstar says their value estimate, they're undervalued by 15%. I don't know how they got that number. Tesla is overvalued by CFRA. I would trust this one more. CFRA is a little more accurate in my findings. They say they're 31% overvalued. And I said they were 3 times overvalued. So so maybe the target number to start dollar costing in this stock is maybe 147. That's where their fair value is. But here's something that CFRA said. They said that the catalyst for the company, they're delivering the semi, which electric semi. They have the Cybertruck coming out in the middle of this year. Optimus Robot, and they have a Roadster. So they have reservations of 1.7 million units, and they're a beneficiary of the Inflation Reduction Act, and so that they're going to have eligible cars that give tax credits, so that makes their cars more affordable. And not every car has a tax credit allowed for it. So, and they're pretty lucky that some of theirs are. So, anyways, that's good to go over that stock, even though it's overvalued right now. What we have to do is we have to wait for a pullback, either to here. Right now it's right in the middle of the trend lines. We have to wait for it to pull back to here, or for it to drop back down to here, which probably won't do, but people will forget about this news story in a month or two in the middle of let's look at this. Hold on. Okay. So in September, whenever stocks are selling off, we have a new crisis, Iran crisis or whatever. People will forget about this charging network, and they'll be selling Tesla off in the August, December, maybe October timeframe. That's the time you have to make a mental note. Yeah, this is a really cool stock. It's overvalued now, and then whenever the stock market sells off, then you say, okay, I remember that. We're going to start dollar costing, put a little bit at a time when that opportunity rises. Okay, what else? Okay, so we have another article on Visa and MasterCard, because we've been following these stocks. There's a new legislation potentially coming that says they might have to share some of their processing fees with other companies. So if you make a transaction with Visa, they're saying that you could route it through Discover or American Express for the fees. So that's pretty bogus. I don't think they're going to get away with doing that, but if they do, Visa's not going to make as much money as they used to, and MasterCard. Visa has 61% of the United States, 40% global transactions. That's almost a monopoly. That's getting up there very close. MasterCard is 25%. So between MasterCard and Visa, that is a good 70% of the world's, America's transactions. And that's not going to go away. It's not going to go away in the next 10 years unless Elon Musk comes up with, something for Twitter or something that's a little more that's used more. But right now they have the great thing about Visa and MasterCard, they have if you buy something and, it was a bad transaction, they'll cover you. Whereas every other company gives you a hassle. Like PayPal, you try to get money back with the PayPal, it's not going to happen usually because they're not as um, they're not as good as that. So you have more of a stickiness to this Visa and Mastercard. And anything else? Okay, so what I'm going to do is I'm going to go over. We do this every month or two. Visa and Mastercard. A little bit later on, not now, but there's a article on solid Vanguard Fund reveals its knack for finding top dividend stocks. So Visa and Mastercard are examples of dividend-paying stocks that grow their dividend over time. So they're included with this top dividend stock company. Let's say Morningstar. Yeah. So this Vanguard dividend growth. Where's the symbol? I don't have it here. Okay, Vanguard dividend growth. They interviewed this guy that runs the dividend growth company, mutual fund, and he was saying about how he chooses these stocks. He basically buys the stocks maybe 20 years ago, 30 years ago, and as long as they continue to increase their dividend over time, and as long as they grow the shareholder value, he keeps the stock in the portfolio. And some of his favorite stocks are Microsoft. He's held that since 2002. He says it's the gold standard of what we're looking for because if you look back over history, Microsoft has a period of time where people thought they were losing their way, but they were actually constantly adding value to the enterprise. Like they most recently invested in OpenAI, and that's becoming like a super, growth engine, allowing them to increase their dividend. But they basically were saying that Microsoft has a dividend of 30% of their free cash flow. So they say as long as the dividend rate is lower than 50%, then there's room to grow the dividend. So their Microsoft payout ratio is below 30%, which is below the sweet spot. So that allows them to increase over time. And the important thing about dividends, whenever you have increasing dividends, that allows you to keep up with inflation. So if inflation grows at 2% a year, and Microsoft's dividend will grow, and that will allow you to have dividend income as you hold the stock over time and not lose buying power. They also talked about United Health as another one. They have lots of avenues for growth, and they have been ahead of others anticipating where the industry is going. So we're going to go over United Health, Visa, MasterCard, because these are some of his favorite ones. And he also mentioned Coca-Cola and Pepsi's as some of his favorite holdings. So what I did was I mapped out, you can search for Vanguard dividend growth and Morningstar. And you can see Morningstar gives you all of the top holdings of the stock, of the mutual fund. And I highlighted some of the ones we're following. It's always nice to see a mutual fund holding the same things that you've been following. And I also noted the year that they bought the stock. And so you can see that McDonald's and Microsoft and Nike, they're all long-time holdings for this company. We haven't followed Honeywell, so maybe we can look at some of these later on. But the article is saying about how he likes McDonald's because they're investing in technology. Like if you order through the app, you get free French fries, and that'll allow them to increase their sales. So every one of these companies are reinventing themselves in a way. Like Nike is reinventing themselves as a order from home company instead of ordering at the Foot Locker. And you see, Stryker does like hip replacements. And TJ Maxx, I'm surprised this is their top holding, but They do reselling of excess goods from other companies like clothes. And so they have Visa and MasterCard in their holdings. So they both pay dividends, and Procter and Gamble, Pepsi, and Johnson and Johnson. So that's a good sign that we're following similar stocks from this mutual fund has gained 10% a year average since inception. So that's better than most mutual funds. And it's a conservative. It's a conservative. Most of these are conservative stocks, and so that's kind of my portfolio's. It's gained like 12 or 13% a year since I started 12 years ago. So so I'm kind of proud of that because I like to buy and hold, and I try to buy and hold similar stocks to this. Okay, so again, I showed you Pepsi, how it's pretty good time to buy that one because it's oversold. No one wants it right now. Let's look at some of the stochastics for the indexes. It seems like right now we're at the top range of our S&P 500. We do have a lot of excitement in the stock market, but looks like we're right in the middle right now. It's pretty dangerous. I wanted to see the hold on, healthcare. The one of the best performing stock indexes last year is underperforming this year, basically, and because it has a dividend, and no one's really excited about dividends in conservative stocks whenever just other stocks are returning 30%. So right now we have almost every one of the drug stocks we're following, or they're in a downtrend similar to this XLB. So it seems like whatever worked last year really good is not working good this year. So I just wanted to show you that. Where were we here? Okay. Okay, so another one of the stocks listed in that dividend mutual fund, Vanguard Dividend Growth Mutual Fund, is United Health. We've been looking at this for a while, and so according to Yahoo Finance Statistics, its forward PE is 19, and its PEG ratio is 1.5. So it's about 1.5 times overvalued. And their return on equity is really good. That's double the 12% we're looking for. And the profit margin is decent. So the earnings summary, they're growing at 12%. Their PE is 22, so they're about 1.8 times overvalued. But they have consistent growth. The great thing about you, that's why you have in this United Health. They bought it in 2011 and they held it. A lot of times the mutual funds look for companies that have this consistent growth. You don't see any red in there. You don't see quarters that are way off 1 month, and they have a consistent amount of new hires in the United States that are signing up for their plans. So the economy, as long as the economy is doing good in America, this will kind of go along with the economy. So it's a good way to diversify, but right now it's a little bit overvalued for my taste. But it does pay a dividend, though. Okay, so there's an article that came out that Visa and MasterCard are fighting off a new UK mass actions over fees. So everyone's coming after the leaders in the world for transactions. The problem with Visa and MasterCard, let's see. Right now they have these incredible margins. Both Visa and MasterCard have 50%, 40%. That means they're really efficient companies, and it doesn't cost them that much to run their company for the money they make. They basically take a toll of transactions that are made in the world, so on their card network. And you can see that MasterCard has a return on equity of 154, profit margin of 40. Now what they're saying right now is if they have to share some of that revenue with other people, like doing the back-end transactions for the company and allowing that to be given to other companies like Discover and other that will make these profit margins go down exponentially. This will be like 12 if that happens. And this will be, instead of 154, it'll be like 20. And it won't be as profitable and it won't grow as much. So let's hope it doesn't happen, because then they lose their some of their moats and some of their easy money they make right now. So both of the Visa and MasterCard, they're selling at a premium, like 1.5 times. Their PEG ratio is 1.5. So, but if this passes and they have to share their network, this new problem here for them, then they're not going to be as profitable. Right now, look how consistent this is. This is going up in a straight line, but it's growing like 13%. And so it trades at a premium because they can continually charge more and more as there's more transactions in the world. And right now, there's 90% of transactions are through cash in the world. And their thesis is that they're getting into more underdeveloped countries, and they become the standard, and more transactions go through their network. And but that news article could change this, and that could be really bad. But right now, MasterCard is growing at 16%. The PEG ratio is 2.25. So the great thing about the reason why that dividend growth mutual fund holds this is because they continue to grow steadily, even in good times and bad. Look at this 2003, when everyone else was struggling. Look, we had a chance to get that down here, the stock, because there was a sell-off last year. Oh no, in the middle of this year. So so it's these qualities companies you got to watch whenever the market sells off, because they'll still continue to grow as long as the government doesn't impose rules on them or whatever. So I thought that was interesting. Let me see. I already talked about this breakaway momentum, and we're going to follow this. I think that was a good call by Walter Deemer. He really hit that at the bottom of the sell-off from last year. You see. Okay, so that's what I had prepared in this slides, but I could go over some of the stock movers for today. I think that'd be interesting. Okay, let's look at the sectors. They're going up and down. Okay, regional banking is down a lot today. I don't know why. Oil. Okay, what's going up? Let's look at what the S&P has done since we started this. The S&P is up fractionally today. Okay, so I think, so what I see here is, let's look at our stochastics for the S&P. Okay, so everyone in the stock market knows that we're basically hitting this prior high from before. And, we're just kind of topping out on that. We're going up just a little bit, but everyone knows that we got to pull back some after you've taken such a big move. I think that's kind of what's happening today. And we're overbought. So let's look at some more of the sector performers here. We have consumer discretionary doing good. So things that are technology. Okay, I don't see anything common here. Let's go to the individual stocks. Tesla's up from that news story that GM's going to be added to their network. What else is happening? There's some semiconductors up today. AMD, Qualcomm, they're all AI oriented. Netflix is up because they implemented a password sharing issue where you can't share your password anymore, so people are signing up like nuts, and that's really good for Netflix. They were worried that they would lose viewers, but actually they're actually signing up after they stopped password sharing. Dish Network's down because they could go out of business, and that means that T-Mobile story last week, and where T-Mobile, AT&T, and Verizon went down because of a possible threat from Amazon, that was bogus. So that'll never happen. So a lot of the telecoms most likely will be going up because of that, because it's not really an issue. There's a lot of false stories out there. We were saying last week that even if Amazon bought Dish and they implemented their own network, it won't be good because the bandwidth is bad. You need to have spotty calls. So let's see, Comerica. I guess we have some bank companies that are going down again. So they're saying that there could be another leg down for the banks. Maybe if we look at our S&P, we can predict the next thing to go down. I think the bank shares, there's a lot of commercial real estate issues in the bank world. And as soon as those leases come up and they're not renewed, then there could be a crisis there. That could be a reason for the stock market to go down into the, as we're topping out right now. I don't know. Let's look at some more of the market movers. There's nothing common I can say about that. Let's look at NASDAQ. Tesla, Adobe, Netflix, Advanced. Okay, so there we have four companies: NVIDIA, Qualcomm, AMD, companies that do AI chips. So AI is still a hot issue, and that's not going to go away, it seems. The things that are going down the most are high PE stocks. So Enphase Energy is high PE. The CrowdStrike, Moderna is low PE. Nothing really that in common. Okay, that's good. Intel they were late to getting into AI, so they're the opposite of AI actually. So maybe the AI companies are going up, the ones that are not are going down. United Health, consistent. These are all dividend growth companies that we're reviewing in that dividend mutual fund. So those are the ones doing the best today, and ones going down the most. I have no insight into that. Okay. All right, so that was good exercise. And now, is there anything anyone wanted to go over? Any topic you had in the top of your mind or anything? No. Okay, I'll take that as a no. All right, so what we're going to do is we're going to look at some of the articles that are coming out today in Yahoo Finance, my favorite place to go. Okay, GameStop had a problem. This is the stock with the people running up the stock and then selling it at the top and leaving the suckers behind. That they just lost the CEO, and they were late on their earnings report. So it's just a loser stock. We were saying that way back when. This is very dangerous investing in those kind of stocks. Let me see. Okay, we were talking about how crypto stocks like Coinbase or Coinbase was kind of uninvestable because of the in general the crypto world is pretty ugly, and it's not very reliable. And this is another indication. Coinbase went down like 20% because they're being sued by the SEC for being an unregistered exchange. So anything involving crypto is like, it's not even an investment. It's just like gambling. The one interesting thing about someone asked me the other day, what's the difference between gambling and the stock market? Isn't stock market gambling? And I said to them, the difference between the stock market and gambling, like going to a casino, is in investing, if you choose quality stocks, time is on your side. So if you invest in 10 years, that stock that you invested in or the index, there's a 90% of chance that you'll make money in your investments. Whereas if you invest in gambling, or if you gamble into casinos, the longer you stay there, the better chance of you losing, because that's the way the odds work. I used to program slot machines, so I know that. Um, so that's a good thing to keep in mind. Buy and hold, and even though things look bad, if you have quality stocks, over your your chances of success increase the longer that you hold the stock. So so that's why it's kind of dangerous to try a strategy of buying and selling and trying to top the market and trying to get out whenever it's going down and get in when it's going up. I just really hard. It's a really hard industry, and you're playing against people that are professionals, and it usually never works. Okay, so let me see. What else can we say? Okay. Another good thing about Tesla is they're a leader in creating batteries. So this says lithium batteries are the new oil, and that got me. That story that I read here was what got me thinking about how Tesla can be the new ExxonMobil. And ExxonMobil, if we replace in 5 years, if the majority of cars made are electric vehicles, then perhaps Tesla could be the new energy play as a maybe an ExxonMobil replacement. So that's really interesting. It's not in the numbers right now, but could be as we follow this stock. But one thing I did, in reaction to this story, this what is it, Tesla GM partnership, is I sold my other stocks, my ChargePoint and the other holding that I had. You see, let's look. This is worth it. Okay, we're almost there. Okay, forget it. Well, anyway, it's whenever you see a news story and you know your thesis is shot, you got to like move on to the next investment and say, my thesis was wrong, and you have to move on. I've done that a couple of times, and when I really mess up on a thesis, but I only had 0.5% invested in those stocks, so it wasn't that big of a loss. It was just I wanted to be in that industry, and when a better solution comes around, you got to admit your failure and move on. All right, so let's look what happens next week in the Fed meeting. That's next Wednesday. That could move the market up and down. Right now, everything's going up. So I think they call that buying a rumor, selling the news. Right now, we have everything's going great, going great, going great, and you have the catalyst, the Fed meeting. Most likely it'll go down because the market will need a reason to go down, and that's a good reason more than anything. So let's hope it doesn't, but that's something to look forward to. All right, well, thanks for attending, everybody.
Thank you, Greg.
Thank you, Greg.
Yeah, have a good weekend.